Hi, Lee Phillips here, talking about the new Trump tax laws, however you want to say that. The Tax Cuts and Jobs Act, signed by President Trump, December 22nd, 2017, which took effect January 1st, 2018. The corporate tax in the United States before the Trump Act was one of the highest in the world. Now it is a flat 21%. Corporations pay 21% of their income. Doesn't matter how much they make, how little they make, 21%. Which isn't bad. That's lower than your personal tax rate in many cases. So would it be advantageous to have a C corporation? Now that could be an LLC taxed under taxed under Chapter C of the IRS code, just like a corporation can be taxed under Chapter C of the IRS code. Now, prior to the Trump tax laws, the answer was no and hell no, basically. You don't want a C corporation because the only way you can get money out of it is to have it either paid out as a salary, subject to the Social Security, FICA, FUTA, and all that crap, 16% tax, right now anyway, and it goes up all the time, or you pay it out as a dividend, which is double taxation, because the C corporation pays its own taxes, and then when it pays out the dividend, it doesn't get a deduction for that dividend that it pays out. And when you get the dividend, you have to take it into your income and pay tax on it. So it's taxed at the corporate level, or whatever tax rate that was, and it's taxed at your level as personal income. So don't tell me that corporations don't pay taxes. They do. With the 21% though, that means that the C corporation or the C structure could store money and have it paid taxed at 21%. That's not bad. There are a lot of ifs, ands, and buts. For example, if you have excessive earnings and you keep that money in the C corporation, the IRS can basically take it away from you. But if you really have a project that you're saving money for, maybe you want to tax it under Chapter C, pay the 21%, and then save it and then spend it on your project. But you'd better be very careful because the excess earnings tax is big time, and you don't want to run into it. Generally, though, my answer is still you do not want taxation under Chapter C of the IRS code, particularly if you're in real estate, someplace where you have passive income anyway, or unearned income, because that's not subject to the Social Security, FICA, FUTA, and all that garbage. Whereas if it's in a C, the only way you can get it out is to have it be a wage, subject to the social taxes. So you want a pass-through entity in most little businesses, pretty much definitely in real estate, but under the new Tax Cuts and Jobs Act, you might want to run some numbers and see if the C taxation structure, Chapter C taxation structure, is going to be advantageous to you. And there's no question that we now have a lot more cases where it could be advantageous to you to have it taxed under Chapter C. And my answer may not be no and hell no. You don't want to see taxation structure. Think about it.